Thank you for listening to the Financial Lens episode titled The Effect of Interest Rates on Investments. Interest rates have a significant effect on the value of stocks and bonds. When you look at bonds, when interest rates go up, the value of bonds goes down. The same is true with stocks. As interest rates go up, the value of stocks goes down. Let's take a look at why that is. And the way we're going to look at it is looking at bonds that have changes in values over time as interest rates change. So let's assume that years ago you purchased a bond for maybe $1,000, and that bond was paying 5.5% interest. Well, 5.5% interest was the going rate of bonds at that time, so you purchased the bond, and over the ensuing years, let's assume that the interest rates went down, which is really what happened over the last 5 years or so. Interest rates are going down, and the new bonds that are being issued are not being issued for 5.5%. They're being issued for 5, 4.5%, 4%. And the bond that you have that's paying 5.5% is really a good deal. It's an attractive bond. And if someone wanted to buy that bond from you, they would be willing to pay more than $1,000 for it. Why? Because they're getting a 5.5% return where the other bonds are paying 4%. New bonds are paying 4%. So they're willing to pay you a higher price for it, because by paying you a higher price for it, they'll get higher interest for that bond until it matures. Now, if interest rates reverse the other way, and let's just say that your bond that's paying 5.5% is going to pay 5.5% for the entire life of the bond, as interest rates start climbing back up from 4 to 4.5 to 5.5%, now your bond that's paying 5.5% is equivalent to what other bonds are paying in the marketplace. So no one's going to pay you a premium for your bond. The premium that you would earn on that bond has gone away. And so the bond actually, in a way, lost money as interest rates went up over the last few years when the interest rates went back up to 5.5%. Now, if interest rates continue to go up from 5.5% to 6.5%, 7%, 8%, now all of a sudden your bond isn't all that attractive. People don't want your 5.5% bond because they can get a bond for 8%. So if you want to sell your bond, you're going to have to sell it for a loss. Now or for a lower price. Someone will perhaps be interested in buying that bond because they'll buy a bond that pays only 5.5%, and they'll get a lower interest. They'll get 5.5% compared to maybe the 8%. But when the bond matures, they'll be able to get the full price that you paid for it when it was issued and make a profit on that end. So they'll take a lower interest rate until the bond matures, and then they'll make up that lower interest when the bond matures. When we look at stocks work the same way as bonds. When interest rates go up, they'll lose value. And so why is that? Because first of all, when interest rates go up, corporations are going to be less interested in borrowing money to expand their operations. They're not going to be able to build their product base. They're not going to be able to build out their business. But more so, what happens is when interest rates go up, consumer demand goes down for products that require them to borrow money. Now, if they're buying toothpaste and paper towels, that's not going to affect the value of your products because people don't need to borrow money to buy those types of products. But if they're thinking about buying appliances, cars, or homes, they have to borrow money because many people don't have the cash to purchase them. It will cost them more money to buy your product because they'll have to pay more interest to purchase it. As a result, they may be less willing to do that, and the demand for your products goes down. Because stocks are tied to the economy and demand for products, when the demand for products goes down, the economy slows down and your profitability goes down. So you see, when interest rates go up, the value of bonds and stocks both go down. So they cease working in a way that one goes up, the other one goes down. They cease working this way. When interest rates go up, they both fall. Thanks for listening to our episode, The Effect of Interest Rates on Investments.